Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Thanks for having me back.
Always great to have you. So, what if I told you that the investor who made the absolute most money on Wall Street over a massive 7-year study was dead wrong on like 70% of their trades?
It sounds completely made up, right?
Right. I mean, today's deep dive is entirely about shattering that Hollywood myth of the market wizard.
Oh, yeah, the guy in a suit who just never loses.
Exactly. Because it turns out building wealth isn't about having a crystal ball to perfectly predict the future. It's actually about the mechanics of what you do immediately after you click that buy button.
And that statistic completely upends how most people approach the market. I mean, we are culturally conditioned to believe that top-tier fund managers are practically fortune tellers.
Yeah, like they have some secret knowledge we don't.
Exactly. We assume they analyze a company, they know exactly where the stock is headed, and they just sit back as the profits roll in because their ideas are flawless.
But the data tells a very different story.
Right. When we look at the actual data, the reality is far more forgiving, but it also requires a lot more discipline.
And the scale of the research backing this up is really what caught my attention. We're looking at a landmark study by Freeman-Shor.
Yeah. The sample size is incredible.
It really is.
Yeah.
He didn't just run a survey. He analyzed hard transactional data. He tracked 45 elite fund managers over a 7-year period.
Wow.
Yeah, covering 1,866 actual investments. These are professionals managing billions of dollars.
Right.
And the undeniable finding was that their winning stock picks made up only 49% of their total trades.
Less than half.
Exactly. You can flip a coin and theoretically have a higher success rate than the brightest minds in finance.
What's fascinating here is that this finding holds up across multiple analyses. Like a 2026 review by the CFA Institute covering the book Stock Market Maestros found the exact same phenomenon.
Wait, really? The exact same number?
Pretty much. Out of all the top-tier investors they analyzed, not a single one maintained a win rate over 57%.
That is just wild to think about.
But the real shocker, like you mentioned earlier, was the outlier. The specific investor who generated the absolute highest total returns out of everyone in the study. They only picked winning stocks 30% of the time.
Okay, let's unpack this because we really need to break down the mechanics of how that is even mathematically possible.
Yeah, it breaks your brain a little at first.
It does. If a beginner applies standard grading logic, like in school, a 30% is a massive failure. You'd assume you'd go bankrupt.
Right, you'd think they'd be out of a job.
But think about this in terms of baseball, right? Imagine a player who strikes out 7 out of 10 times at bat.
Terrible batting average.
Terrible. But the 3 times they actually hit the ball, it's a game-winning grand slam. Let's look at the math with asymmetric risk. Say you make 10 investments of $1,000 each.
Okay, 10 grand total.
Right. You wrong on 7 of them. But you manage your risk and you cut those losses at just 10%. So you've only lost $700.
Which is very manageable.
Exactly. Now, on the 3 investments where you were right, you let them grow by 200%. Those 3 winners generate $6,000 in profit.
Wow.
So you were wrong 70% of the time, but you still walk away with a net gain of over $5,000.
And that breakdown right there highlights the core mechanism of wealth creation.
It's not about being right all the time.
Not at all. Since the data proves we are virtually guaranteed to be wrong half the time, the most logical place to start our analysis is how these elite investors handle their inevitable mistakes.
Because everyone makes them.
Right. Freeman-Shor's research actually categorized how investors manage losing positions into 3 distinct psychological profiles. And the first one, which is statistically the most destructive to a portfolio, is a profile he calls the rabbit.
The rabbit. I mean, the imagery is fitting, right? Like a rabbit freezing in the middle of the road when it sees headlights.
That is exactly what happens.
When a rabbit investor buys a stock and the price suddenly drops, they experience this intense psychological phenomenon known as loss aversion. Instead of evaluating the situation, they just freeze.
Yeah, they just panic.
Say they bought a tech company specifically because they expected a revolutionary new patent to be approved. But then the news breaks that the patent was flat out denied, and the stock tanks.
Right.
The entire foundational reason they bought the stock in the first place, their investment thesis is completely broken.
But instead of selling and moving on, the rabbit engages in psychological avoidance.
They just bury their head in the sand.
Exactly. They refuse to log into their brokerage account. They ignore the financial news. They just sit there hoping the market will miraculously reverse course.
Which rarely happens.
Right. Mechanically, they're falling victim to the sunk cost fallacy. They don't want to click sell because doing that transforms a theoretical paper loss on a screen into a permanent, real loss.
Yeah, it makes it real.
And the data shows this specific behavioral trap is how small, manageable 10% mistakes spiral into devastating 40% or even 80% portfolio wipeouts.
So hearing that, a lot of listeners might think the obvious answer is just a rigid, automated rule.
Like a stop loss.
Right, like why not just set a hard mechanical stop-loss order on your account? You just tell the broker to automatically sell any stock the moment it drops exactly 10%.
Yeah.
Completely removing emotion from the equation.
Setting a mechanical trapdoor sounds logical. I totally get why people do it. But in practice, it can actually damage your returns in a volatile market.
Really, how so?
Because prices fluctuate wildly based on daily news, algorithmic trading, and broad market panic. Especially right now, with the Trump administration in office and the market reacting so aggressively to every new policy or tariff headline.
Oh yeah, the daily news cycle is just chaotic right now.
Exactly. So if you use a strict 10% automated rule, you will constantly get whipsawed. The market dips 11% on a Tuesday due to a scary headline. Your broker automatically sells your shares, and by Thursday, the stock is hitting new all-time highs.
Oh, that is the worst feeling.
It is. You locked in a loss on a great company for absolutely no fundamental reason. So to understand the better approach, we have to look at the next two investor profiles from the data, which are the assassin and the hunter.
I love the assassin label because it implies this ruthless efficiency. An assassin does sell quickly, but they aren't looking at the red numbers on the screen.
Right, they look at the business.
Exactly. They're looking to the business facts. They sell purely because the core investment thesis is broken. So if they bought a retail company because of an aggressive expansion plan, and then the company unexpectedly fires the CEO and cancels the expansion, the assassin kills the position immediately.
They don't even hesitate.
Right. It doesn't matter if the stock is down 5% or 20%. The story they invested in is over. So they get out.
And then you have the hunter, which introduces a strategy that feels deeply counterintuitive to most people.
Oh, yeah. This one is tough.
It is. A hunter watches their stock drop in price, but they don't look at the ticker. They look at the company's underlying mechanics.
They look under the hood.
Right. Let's say the broader economy has a rough week and drags the entire stock market down 15%. But the hunter looks at their specific company's quarterly report and sees that profit margins are actually widening.
Okay.
Debt is being paid down, and they are stealing market share from competitors. The actual business engine is stronger than ever.
So to a hunter, that price drop isn't a threat. It's a massive discount. They don't panic sell. They recognize the discrepancy between the stock's price and the company's actual value, and they buy more.
They double down.
But there is a fine line here, right? Like, how does a listener tell the difference between being a hunter finding a bargain and just catching a falling knife?
That's a great question. The differentiator is entirely based on the thesis. A falling knife is a company where revenues are shrinking, leadership is chaotic, and the industry is shifting away from them.
But the stock is cheap.
Right. The investor buys more simply because the stock used to be higher and they think it has to go back up. That is dangerous.
Very dangerous.
A hunter only buys a dip when the verifiable business fundamentals are actually improving. You are managing the thesis, not the stock price.
That makes total sense. And that covers the strategy for losing. But the research points out a massive blind spot that I think most people just completely ignore.
Oh, absolutely.
Stopping the bleeding on losers is really only half the battle. The data reveals that everyday investors, and honestly a surprising number of professionals too, are incredibly destructive when it comes to managing their winning investments.
Yes, and we can categorize this behavior under the profile called the rater. And the findings on raters are staggering.
The numbers blew my mind.
According to the research, 66% of all winning stocks were sold prematurely for a very modest profit of 20% or less.
Just 20%.
Yep. Investors saw a small gain and immediately liquidated their positions. But the real tragedy of this is that 61% of those exact same stocks continued to climb significantly higher after they were sold.
That hurts to even hear.
Right. Investors are intentionally amputating the compounding growth of their absolute best assets.
And the psychology behind that is fascinating. We are so desperate for that dopamine hit of a win that we cash out early just to prove we were right.
We want to lock it in.
Exactly. It's the fear of a stock dropping back down and erasing our unrealized gains. We want the safety of putting that profit in our pocket. And the crazy thing is, Wall Street actually encourages this behavior with the whole mechanism of target prices.
If we connect this to the bigger picture, target prices are honestly one of the most misleading concepts pushed by financial media.
They really are.
An analyst will issue a report saying a stock currently at $100 has a target price of $130, and investors just anchor onto that specific number.
Like it's a finish line.
Exactly. The moment the stock hits 130, they blindly sell everything, assuming the game is over and the stock has reached its absolute peak.
But a company isn't a static object with a fixed value. Let's use a historical business example for the listeners. Imagine buying Amazon stock back in the late 90s when they literally just sold books.
Oh, man.
Right? If you set a static target price to sell once you doubled your money, you would have felt like an absolute genius for about 6 months.
You'd be thrilled.
But you would have missed out on them dominating global logistics, inventing modern cloud computing, and becoming a trillion-dollar empire. Your target price was based on a bookstore, but the company evolved into a massive infrastructure giant.
Which is exactly why the ideal profile for managing winners is the connoisseur.
The connoisseur.
Right. A connoisseur doesn't hold a stock blindly out of loyalty, ignoring new risks, but they refuse to sell a winner as long as the underlying fundamentals of the company continue to improve.
As long as the business is good.
Exactly. If sales are growing, margins are expanding, and leadership is executing, the connoisseur lets the stock run. They allow the math of compound interest to actually work in their favor.
It's just like owning a small, local business. Imagine you own a neighborhood pizza shop that is absolutely booming.
Okay, I like pizza.
Right. Your supplier costs are down, foot traffic is up, and you're generating massive cash flow every single month. You wouldn't wake up one morning and sell that incredible wealth-generating business just because it hit some arbitrary revenue number you guessed a year ago?
Yeah? No, that would be crazy.
You keep holding the business because the fundamental economic engine is strong. Stocks are no different. They are fractional ownership of those real-world economic engines.
Yeah, it requires a profound mindset shift to view stocks as compounding machines rather than, lottery tickets.
It really does.
Unfortunately, when we shift our focus to the current environment right now, specifically the market data from August 2026, we are seeing retail behavior that is the absolute opposite of the connoisseur strategy.
It's pretty scary out there.
It is. Investors are engaging in mechanics that practically guarantee wealth destruction.
Here's where it gets really interesting, because the latest FINRA data on margin debt in the U.S. paints a very alarming picture. Right now, U.S. margin debt has hit a staggering $1.42 trillion.
Trillion with a T.
Trillion, which is a 39% increase from just last year alone. For you listening and analyzing the structural risks of the market, it's really crucial to understand how margin debt mechanically changes your investing reality.
It changes everything.
Because when you buy shares with your own cash, a stock can drop 50% and you still own your shares. You can patiently wait years for the business to recover.
But margin debt is money borrowed directly from your broker to buy more stock than you can actually afford.
It's borrowed money.
Right. It acts as leverage, amplifying your gains, but fatally amplifying your losses. If you are heavily leveraged and your portfolio drops 20%, your broker issues a margin call.
And they don't ask nicely.
No, they demand you deposit cash immediately to cover their risk. And if you can't, the broker has the legal right to forcefully liquidate your assets. They sell your shares at the exact bottom of the market.
Wow.
Your holding power is completely stripped away.
And the leverage isn't just in borrowed cash, right? It's heavily concentrated in the options market right now. The data shows an absolute explosion in zero DTE options. That's 0 days to expiration.
It's a massive trend.
These contracts now make up a record 66.2% of all S&P 500 options volume. Let's break down why that specific mechanism is so dangerous for the average person.
Yeah, so an options contract gives you the right to buy or sell an asset at a certain price. Traditionally, investors buy options that expire months or even years in the future to hedge their portfolios against long-term risk.
On an insurance policy.
Exactly. But a zero DTE option expires the exact same day you purchase it. Mechanically, these contracts are subject to aggressive time decay.
Okay, so the clock is ticking immediately.
Fast. When you buy one, the sand in the hourglass is practically empty from the start.
So if the broader market doesn't swing violently in the exact direction you predicted within, like, a matter of hours, the value of that contract decays to literally zero by the closing bell.
You lose everything you put into it.
Right. You aren't investing in the cash flows of a growing business anymore. You are making a binary, heavily leveraged bet on the market's daily mood swings. And honestly, the house always has the mathematical edge.
It is the ultimate manifestation of FOMO, the fear of missing out.
Oh, absolutely.
This raises an important question about how people react to short-term news. A recent Reuters report from early August captured this perfectly. Over just a few days, the S&P 500 surged 5.8%.
A huge jump.
Right. But instead of analyzing why the market moved, retail investors just panicked that they were missing the rally. They rushed in and bought massive volumes of short-dated call options right at the top of the surge.
They just saw the green line going up on their screens and threw leverage money at the peak.
Just chasing it.
Exactly. And this completely destroys what analysts call payoff asymmetry. Payoff asymmetry is the structural balance between how much capital you are risking versus your realistic potential reward.
It's your risk-to-reward ratio.
Right. When you operate like a connoisseur, buying a fundamentally strong company with cash and letting it grow for a decade, your downside is capped at exactly what you invested, but your upside is theoretically infinite.
But when you use extreme leverage and zero-day options, you completely invert that asymmetry. The researchers use a brilliant analogy to describe these high win rate, catastrophic loss strategies.
I love this analogy.
It is the equivalent of picking up pennies in front of a steamroller.
That visual just perfectly captures the hidden risk. You might step in front of the steamroller and pick up a penny 99 times in a row.
And you feel invincible.
You really do. You make a tiny, quick profit each time. Your win rate is an incredible 99%. But on the 100th attempt, you trip.
And that's it.
The steamroller crushes you, and your entire portfolio is wiped out. It simply doesn't matter that you were right 99 times, because the mathematical size of your single loss was fatal.
Which brings us to the unifying theme of the 2026 Stock Market Maestros book. It really summarizes the core philosophy of these elite managers in 4 simple words. Execution trumps ideas.
Execution trumps ideas. Because most people spend 90% of their energy hunting for the perfect stock tip, right?
They want the next big thing.
They think the idea itself is the magic key to wealth. But the data proves the idea is just the starting line.
Exactly. Your true superpower as an investor is portfolio management. It is the discipline to write down your thesis before you buy.
Write it down on paper.
Yes. And it is the emotional control to act like an assassin and cut a loss when that thesis breaks, rather than freezing like a rabbit.
Right.
It is the patience to act like a connoisseur and let your winners compound over years, resisting the raiders' urge to take a quick 15% profit.
Yeah.
And above all, it is the wisdom to avoid the steamroller of $1.42 trillion in margin debt.
So what does this all mean for you listening right now? Let's tie this directly to how you evaluate your own financial journey.
Yeah, let's bring it home.
If there's one major takeaway from all this data, it's that you need to stop tracking your investing success like a high school exam. Being wrong on a stock does not mean you failed.
Not at all.
The greatest investors on the planet are wrong 50 to 70% of the time, but they survive their mistakes because they keep them small, and they build massive wealth because they squeeze every drop of potential out of their correct decisions.
And as we wrap up today's analysis, there is one final, almost paradoxical finding from the research that you should really carefully consider.
Oh, this is my favorite part of the study.
When the authors analyzed these master investors, they discovered that their actual daily rules completely contradicted each other.
It's so fascinating. You had some elite managers who relied entirely on complex technical charts, while others in the exact same study viewed charts as completely useless noise.
Totally opposite approaches.
Right. Some utilized trailing stop losses, while others refused to automate their selling at all. You had managers whose average holding period was 15 months, and others who refused to sell anything for less than 8 years.
It looks like pure chaos on the surface, right? But it actually reveals the deepest truth of the study. The secret to their incredible returns wasn't that they discovered one universally perfect formula.
There is no magic formula.
No. The secret was that they built a rigid system of execution that perfectly aligned with their own individual psychology.
That is so key. If you are naturally impatient and hyper-analytical, trying to force yourself to hold a stock for a decade will just cause you constant anxiety,
It'll be miserable.
and you will eventually break your own rules at the worst possible moment. Conversely, if you are risk-averse and prefer a hands-off approach, trying to actively trade daily momentum shifts will destroy your portfolio and your peace of mind.
So you have to ask yourself, are you currently operating under an investment strategy that you just borrowed from a talking head on television?
Or a guy on the internet.
Right. Or does your strategy actually match your own emotional temperament? Because the moment the market experiences real volatility, any strategy that conflicts with your underlying psychology will be immediately abandoned.
That is a powerful question to leave you with today. Understand your own temperament, define your thesis, manage your risk, and let the compounding engines do the heavy lifting. Don't forget to subscribe and hit that like button.